Question 1. Title insurance policies. An owner's title insurance policy typically provides coverage for which of the following situations: A. Losses due to future zoning changes that affect the value of the property. B. Title defects that existed before the policy was issued but were not disclosed during the title search. C. Claims related to structural defects in the property. D. Losses arising from a seller's failure to disclose a past foreclosure. Answer: B. Title defects that existed before the policy was issued but were not disclosed during the title search. Explanation: An owner's title insurance policy protects the property owner from losses due to title defects that were not discovered during the title search and existed before the policy was issued. This includes issues like undisclosed liens, errors in public records, or ownership disputes. It does not cover future events like zoning changes, option A, structural defects, option C, or issues related to non-disclosure of a past foreclosure, option D. The policy is designed to provide coverage for defects in the title that could result in financial loss to the property owner. Question 2. Risk management and underwriting. When assessing risk in title insurance underwriting, which of the following factors is least likely to be considered? A. The financial stability of the property owner. B. The accuracy of the public records related to the property. C. The potential for undisclosed easements affecting the property. D. The history of property tax payments by previous owners. Answer: A. The financial stability of the property owner. Explanation: In title insurance underwriting, the primary focus is on the accuracy and completeness of public records, identifying potential encumbrances such as undisclosed easements and ensuring that there are no outstanding issues related to the property's title. The financial stability of the property owner, option A, is generally not a factor in underwriting decisions, as title insurance is more concerned with the title's legal status rather than the owner's financial situation. Question 3. Scenario-based question. Mr. Roberts is purchasing a property and has been informed that the title search has revealed a possible unresolved lien from a previous owner. The lien is not mentioned in the initial title insurance commitment, and the seller claims it was settled years ago. What should Mr. Roberts do next? A. Proceed with the purchase without further action, assuming the seller's claim is correct. B. Request that the seller provide proof of lien resolution before closing. C. Sign a waiver to accept the property with the potential lien and complete the purchase. D. Contact the Maryland Insurance Administration to dispute the title insurance commitment. Answer: B. Request that the seller provide proof of lien resolution before closing. Explanation: If a potential unresolved lien is discovered during the title search, it is crucial for the buyer to ensure that the lien has been properly resolved before proceeding with the purchase. Requesting proof of lien resolution from the seller, option B, ensures that any outstanding issues are addressed and does not leave the buyer at risk for unexpected financial burdens. Proceeding without verifying, option A, or signing a waiver, option C, could expose the buyer to future claims related to the unresolved lien. Contacting the Maryland Insurance Administration, option D, is not the immediate step for resolving this specific issue. It is better to handle it through the seller and title insurance company. Question 4. Title search and examination. During a title search, you discover a deed recorded in the 1970s that lists a different owner but has no subsequent transfer recorded. What should be the primary concern in this situation? A. The property may be subject to an undisclosed mortgage from the 1970s. B. The chain of title might be broken, affecting the marketability of the property. C. The title search must be updated to reflect modern property values. D. The property could have an unrecorded easement that was not disclosed. Answer: B. The chain of title might be broken, affecting the marketability of the property. Explanation: A deed recorded in the 1970s with no subsequent transfer recorded suggests a potential break in the chain of title. This means that there could be a gap in the historical ownership records, which can affect the property's marketability and the buyer's ability to obtain clear title. It's essential to resolve such gaps to ensure the property's title is clear. Issues like undisclosed mortgages, option A, or unrecorded easements, option D, may be relevant but are secondary to addressing the broken chain of title. Updating the title search for modern property values, option C, does not address the fundamental issue of title continuity. Question 5. Legal framework. Which federal regulation most directly impacts the disclosures required by title insurance companies? A. The Real Estate Settlement Procedures Act, RESPA. B. The National Flood Insurance Act. C. The Fair Housing Act. D. The Truth in Lending Act, TILA. Answer A. The Real Estate Settlement Procedures Act, RESPA. Explanation: The Real Estate Settlement Procedures Act (RISPA) directly impacts the disclosures required by title insurance companies by mandating that they provide a good faith estimate of settlement costs and a HUD-on settlement statement, which includes title insurance costs. This regulation ensures transparency in the settlement process. The National Flood Insurance Act Option B deals with flood insurance. The Fair Housing Act Option C addresses discrimination in housing, and the Truth in Lending Act Option D pertains to lending practices, not specifically to title insurance disclosures. Question 6. Title insurance policies. What is the primary difference between an owner's title insurance policy and a lender's title insurance policy? A. An owner's title insurance policy covers only the lender's interests in the property. B. A lender's title insurance policy is typically transferable to new owners if the property is sold. C. An owner's title insurance policy protects the property owner from title defects, while a lender's title insurance policy protects the lender's investment. D. A lender's title insurance policy covers defects that occur after the policy is issued. Answer: C. An owner's title insurance policy protects the property owner from title defects, while a lender's title insurance policy protects the lender's investment. Explanation: An owner's title insurance policy provides protection for the property owner against title defects that existed before the policy was issued, whereas a lender's title insurance policy protects the lender's interest in the property up to the amount of the loan. The policy does not transfer to new owners, Option B, and it does not cover defects occurring after issuance, Option D. Both policies cover different aspects of risk related to title defects and ownership. Question 7. Risk management and underwriting. Which of the following is an important factor in assessing risk during title insurance underwriting? A. The current market value of the property. B. The amount of the loan secured by the property. C. The accuracy of prior title searches and recorded documents. D. The income level of the property owner. Answer: C. The accuracy of prior title searches and recorded documents. Explanation: In title insurance underwriting, the accuracy of prior title searches and recorded documents is crucial for assessing risk. This ensures that any issues with the title are identified and resolved before issuing the policy. Factors like the current market value of the property, Option A, or the amount of the loan, Option B, may influence the insurance amount but are not directly related to assessing title risk. The income level of the property owner, Option D, is not relevant to the underwriting process for title insurance. Question 8. Real estate transactions. Which document typically transfers ownership of property in a real estate transaction? A. Title insurance policy. B. Warranty deed. C. Mortgage note. D. Closing disclosure. Answer: B. Warranty deed. Explanation: A warranty deed is the document that typically transfers ownership of property from the seller to the buyer in a real estate transaction. It guarantees that the seller has clear title to the property and the right to transfer it. The title insurance policy, Option A, provides protection against title defects. The mortgage note, Option C, represents the borrower's promise to repay the loan, and the closing disclosure, Option D, outlines the settlement costs but does not transfer ownership. Question 9. Claims and disputes. If a title insurance claim is denied, what is typically the first step a policyholder should take to address the issue? A. Contact the Maryland Insurance Administration to file a formal complaint. B. Seek legal advice to initiate a lawsuit against the title insurance company. C. Review the policy terms and request a detailed explanation of the denial from the insurer. D. Cancel the insurance policy and seek coverage from a different provider. Answer: C. Review the policy terms and request a detailed explanation of the denial from the insurer. Explanation: The first step in addressing a denied title insurance claim is to review the policy terms and request a detailed explanation of the denial from the insurer. This helps to understand the basis for the denial and determine if the claim was unjustly denied. Contacting the Maryland Insurance Administration, Option A, or seeking legal advice, Option B, might be necessary if the issue cannot be resolved with the insurer, but these steps are typically taken after reviewing the denial. Canceling the policy, Option D, does not address the issue with the claim and is not a solution to the dispute. Question 10. Practical applications. In a case where an error is discovered in a recorded deed after the property has been purchased, who is primarily responsible for correcting the error? A. The property buyer. B. The title insurance company. C. The previous owner of the property. D. The county recorder's office. Answer: B. The title insurance company. Explanation: If an error is discovered in a recorded deed after the property has been purchased, the title insurance company is primarily responsible for correcting the error if the policy provides coverage for such issues. The title insurance company will typically handle the correction process and address any related claims. The property buyer, option A, should notify the title insurance company but is not responsible for the correction. The previous owner, option C, and the county recorder's office, option D, may be involved, but the primary responsibility for resolving issues covered by title insurance rests with the insurer. Question 11. Title search and examination. What is the primary purpose of conducting a chain of title analysis during a title search? A. To determine the current market value of the property. B. To ensure that all prior owners have legally transferred their interest in the property. C. To identify any potential environmental hazards on the property. D. To verify the accuracy of property tax assessments. Answer. B. To ensure that all prior owners have legally transferred their interest in the property. Explanation. A chain of title analysis is conducted to ensure that all prior owners have legally transferred their interest in the property to the current owner. This analysis helps identify any gaps or issues in the title history that could affect the current owner's legal ownership, determining market value, option A, or identifying environmental hazards, option C, is not the purpose of the chain of title analysis, and verifying property tax assessments, option D, is unrelated to title examination. Question 12. Title insurance policies. What is an example of an exclusion in a title insurance policy? A. Claims related to forged signatures on the deed. B. Liens for unpaid property taxes that are not recorded. C. Errors in the legal description of the property. D. Disputes over property boundaries not resolved by a survey. Answer. D. Disputes over property boundaries not resolved by a survey. Explanation. Title insurance policies often exclude coverage for disputes over property boundaries that are not resolved by a survey. Such disputes are considered risks that title insurance typically does not cover, as they often require surveyors' expertise to resolve. Claims related to forged signatures, option A, and unrecorded liens, option B, are usually covered, while errors in the legal description, option C, might be covered depending on the specific policy terms. Question 13. Legal framework. Which Maryland regulation requires title insurance companies to provide a written explanation of coverage, exclusions, and exceptions to policyholders? A. Maryland Code, Insurance Article SS9, 112. B. Maryland Code, Real Property Article SS3, 101. C. Maryland Code, Insurance Article SS10, 101. D. Maryland Code, Real Property Article SS4, 101. Answer. A. Maryland Code, Insurance Article SS9, 112. Explanation. Maryland Code, Insurance Article SS9, 112 mandates that title insurance companies provide a written explanation of coverage, exclusions, and exceptions to policyholders. This regulation ensures transparency in the policy terms and helps policyholders understand what is and isn't covered. The other sections listed do not specifically address the requirements for explaining policy exclusions and exceptions. Question 14. Risk management and underwriting. Which of the following is a common underwriting criterion for evaluating the risk associated with a title insurance policy? A. The age of the property. B. The credit score of the property owner. C. The presence of any pending lawsuits related to the property. D. The current market interest rates. Answer. C. The presence of any pending lawsuits related to the property. Explanation. Underwriters assess the risk of a title insurance policy by evaluating factors such as the presence of any pending lawsuits related to the property. Pending lawsuits can indicate potential legal issues that could affect the title. The age of the property, option A, credit score of the property owner, option B, and current market interest rates, option D, are not typically considered in the underwriting process for title insurance. Question 15. Practical applications. If a title insurance policyholder discovers a new lien on the property that was not listed in the title commitment, what is the correct course of action? A. Ignore the lien and continue with the property transaction. B. Immediately file a complaint with the Maryland Insurance Administration. C. Notify the title insurance company and file a claim to address the new lien. D. Request a refund of the title insurance premium from the insurance company. Answer. C. Notify the title insurance company and file a claim to address the new lien. Explanation. If a new lien is discovered that was not listed in the title commitment, the policyholder should notify the title insurance company and file a claim. The insurance company will then investigate and address the lien in accordance with the policy terms. Ignoring the lien option A or requesting a refund option D does not resolve the issue, and filing a complaint with the Maryland Insurance Administration option B should be considered only if the insurance company does not adequately address the claim. Question 16. Title insurance policies. Which type of endorsement might be used to provide additional coverage for an owner's title insurance policy? A. Environmental protection endorsement. B. Zoning endorsement. C. Homeowner's endorsement. D. Title defect endorsement. Answer: B. Zoning endorsement. Explanation: a zoning endorsement provides additional coverage for an owner's title insurance policy by addressing zoning-related issues that could affect the property. This endorsement can cover risks related to zoning changes or violations that were not initially disclosed. The environmental protection endorsement, option A, and homeowner's endorsement, option C, are not standard in title insurance policies, and title defect endorsement, option D, is generally not a separate endorsement but rather part of the base policy coverage. Question 17. Claims and disputes. What is a common reason for a title insurance claim to be denied? A. The property value increased after the policy was issued. B. The defect in the title was known to the policyholder prior to purchasing the insurance. C. The policyholder failed to make timely premium payments. D. The property had an undisclosed historical significance. Answer: B. The defect in the title was known to the policyholder prior to purchasing the insurance. Explanation: title insurance claims are commonly denied if the defect in the title was known to the policyholder before purchasing the insurance. Title insurance does not cover issues that the policyholder was aware of at the time of purchase. Changes in property value, option A, and failure to make premium payments, option C, can affect the policy but are not typical reasons for claim denial. Historical significance, option D, is not usually a factor in title insurance claims. Question 18. Real estate transactions. Which document is used to finalize the transfer of ownership and to record the new owner's interest in the property? A. Closing disclosure. B. Warranty deed. C. Deed of trust. D. Title commitment. Answer: B. Warranty deed. Explanation: the warranty deed is the document used to finalize the transfer of ownership and record the new owner's interest in the property. It guarantees that the seller has clear title to the property. The closing disclosure, option A, details settlement costs. The deed of trust, option C, is related to securing a loan, and the title commitment, option D, outlines the terms of the title insurance policy but does not transfer ownership. Question 19. Title search and examination. When reviewing a title abstract, which of the following is most crucial to verify? A. The number of previous owners listed. B. The accuracy of recorded legal descriptions. C. The presence of recent tax assessments. D. The property's architectural design. Answer: B. The accuracy of recorded legal descriptions. Explanation: the accuracy of recorded legal descriptions is crucial when reviewing a title abstract, as it ensures that the property boundaries and descriptions match the legal records. Incorrect legal descriptions can lead to title disputes. The number of previous owners, option A, and recent tax assessments, option C, are relevant but secondary to the accuracy of legal descriptions, and the property's architectural design, option D, is not related to title examination. Question 20. Ethics and professional conduct. Which action would be considered a conflict of interest for a title insurance professional? A. Advising clients on the best title insurance coverage options. B. Accepting gifts from clients as a token of appreciation. C. Ensuring all title insurance policies comply with state regulations. D. Providing detailed explanations of policy terms and exclusions. Answer: B. Accepting gifts from clients as a token of appreciation. Explanation: accepting gifts from clients can be considered a conflict of interest, as it may create a perception of bias or influence in the professional's decision-making. Title insurance professionals should avoid any actions that could be seen as compromising their impartiality. Advising clients, option A, ensuring compliance with regulations, option C, and providing explanations of policy terms, option D, are ethical practices and do not constitute a conflict of interest. Question 21. Title insurance policies. Which of the following statements best describes an extended coverage endorsement in a title insurance policy? A. It covers only the legal costs associated with resolving title disputes. B. It provides coverage for defects that are not revealed by the public records. C. It extends coverage to issues that arise after the policy is issued. D. It ensures that the property's value is protected against market fluctuations. Answer: B. It provides coverage for defects that are not revealed by the public records. Explanation: an extended coverage endorsement provides additional protection for defects that might not be uncovered by a standard title search or are not revealed in public records. This may include issues like undisclosed easements or unrecorded liens. The other options describe different types of coverage or protections that do not fall under the scope of the extended coverage endorsement. Question 22. Real estate transactions. In a real estate transaction, who typically bears the responsibility for ensuring that the title to the property is clear of any encumbrances? A. The seller. B. The buyer. C. The title insurance company. D. The real estate agent. Answer: A. The seller. Explanation: the seller is generally responsible for ensuring that the title to the property is clear of any encumbrances or defects before transferring it to the buyer. This is because the seller must provide a clear title as part of the sale. The buyer, title insurance company, and real estate agent play roles in the transaction but do not have the primary responsibility for clearing the title. Question 23. Risk management and underwriting. What is the primary purpose of a title insurance company's underwriting process? A. To evaluate the financial stability of the property owner. B. To identify and assess the risks associated with insuring a particular property. C. To determine the market value of the property being insured. D. To review the property's historical significance and its impact on the insurance. Answer: B. To identify and assess the risks associated with insuring a particular property. Explanation: the underwriting process in title insurance is designed to identify and assess the risks associated with insuring a particular property. This involves evaluating the title history, any potential legal issues, and other factors that might affect the insurance coverage, evaluating financial stability, option A, determining market value, option C, and reviewing historical significance, option D, are not primary functions of the underwriting process. Question 24. Title search and examination. During a title search, what does the term encumbrance refer to? A. A legal document confirming the property's value. B. A claim or lien on the property that affects its title. C. The process of transferring ownership of the property. D. A survey showing the property's boundaries and improvements. Answer: B. A claim or lien on the property that affects its title. Explanation: an encumbrance refers to a claim, lien, or other legal rights on the property that can affect its title. Encumbrances can include mortgages, easements, or judgments that may impact the property's transfer or use. It does not refer to documents confirming value, option A, the transfer process, option C, or surveys, option D. Question 25. Claims and disputes. What is a preliminary title report used for in the claims process? A. To provide a final decision on a claim dispute. B. To outline the title insurance policy terms and conditions. C. To identify potential title issues before finalizing the insurance policy. D. To document the insurance company's compliance with state regulations. Answer: C. To identify potential title issues before finalizing the insurance policy. Explanation: a preliminary title report is used to identify potential title issues before the finalization of the insurance policy. This report outlines any existing claims, liens, or other issues that might need to be resolved before issuing the policy. It does not provide a final decision on claims, option A, detailed policy terms, option B, or document regulatory compliance, option D. Question 26. Ethics and professional conduct. Which action could be considered? A breach of confidentiality by a title insurance professional. A. Discussing a client's title insurance policy with a third-party vendor without permission. B. Providing a detailed analysis of title issues to a client. C. Explaining policy exclusions and exceptions to a client in detail. D. Ensuring that all documentation is accurate and complete. Answer: A. Discussing a client's title insurance policy with a third-party vendor without permission. Explanation: breaching confidentiality involves sharing a client's information with unauthorized parties. Discussing a client's title insurance policy with a third-party vendor without permission constitutes a breach of confidentiality. Providing detailed analysis, option B. Explaining policy terms, option C, and ensuring documentation accuracy, option D, are ethical and professional practices if done with proper client consent. Question 27. Legal framework. Which federal regulation impacts title insurance by requiring transparency in the settlement process? A. The Fair Housing Act (FHA). B. The Real Estate Settlement Procedures Act (RESPA). C. The Truth in Lending Act (TILA). D. The Homeowners Protection Act (HP). Answer: B. The Real Estate Settlement Procedures Act (RESPA). Explanation: the Real Estate Settlement Procedures Act (RESPA) requires transparency in the settlement process, including providing a detailed disclosure of settlement costs to the parties involved in real estate transactions. The other acts listed, FHA, TILA, PA, deal with different aspects of housing and lending but do not specifically address settlement transparency. Question 28. Title insurance policies. What type of policy would provide coverage for the risk of a previous owner's undisclosed debts? A. Owner's title insurance policy. B. Lender's title insurance policy. C. Environmental risk policy. D. Homeowner's insurance policy. Answer: A. Owner's title insurance policy. Explanation: an owner's title insurance policy provides coverage for risks associated with undisclosed debts or liens from previous owners. This policy protects the property owner from financial loss due to title defects not discovered during the title search. A lender's title insurance policy, option B, protects only the lender's interests, while environmental risk policy, option C, and homeowner's insurance policy, option D, cover different types of risks unrelated to title issues. Question 29. Practical applications. In a scenario where a title insurance policyholder discovers an undisclosed easement affecting their property, what should they do first? A. Attempt to negotiate with the holder of the easement to resolve the issue. B. File a complaint with the local zoning board. C. Contact the title insurance company to file a claim. D. Seek a legal opinion to challenge the validity of these. Answer: C. Contact the title insurance company to file a claim. Explanation: the first step should be to contact the title insurance company and file a claim. The title insurance company will investigate the issue and provide coverage or resolution as per the policy terms. Negotiating with the easement holder, option A, filing a complaint with the zoning board, option B, or seeking legal opinion, option D, may be additional steps, but the insurance company should be contacted first. Question 30. Risk management and underwriting. When evaluating potential risks during underwriting, which of the following factors is most critical? A. The property's aesthetic appeal. B. The number of previous owners. C. The property's compliance with zoning regulations. D. The financial health of the property's current owner. Answer: C. The property's compliance with zoning regulations. Explanation: compliance with zoning regulations is a critical factor in underwriting because it directly affects the legality and usability of the property. Non-compliance with zoning laws can lead to legal issues and impact the title. Aesthetic appeal, option A, number of previous owners, option B, and financial health of the owner, option D, are less relevant to the assessment of title insurance risk.